Well, howdy, folks. It's Mike again, and we've got another in our fundamental series. This one is going to be on quarterly earnings last week. Well, I'm not sure when I'm going to release this, but we recently did a one on sales growth. I would watch that one in addition to this one. I'm going to do an entire series on fundamentals and the way Bill would look at them, as well as how I look at them, which is pretty much the same way that Bill would look at them. I put a lot more weight on sales than he did, but I put just as much weight on earnings as he did, and return on equity and margins and things like that. So we'll do as many episodes as it makes sense to tackle this very important topic. But fundamentals are more for screening to know the universe of stocks or the stocks that you want to buy and within what universe you want to buy. And they're much more important for position trading than swing trading. Swing trading, if you're going to be in there for a few days or a few weeks, it's not that important. It's important, but it's not that important. But if you're going to do position trading, meaning holding weeks to months or even a lot longer than that, it's really about the fundamentals, and you're using the chart to time your entries. Whereas if you're swing trading, it's mostly about the technicals, frankly, is what it is, because the fundamentals are what moves a stock over years and decades. That if you study a chart that has an earnings line and or a sales line on there, you'll quickly see. And a good friend of mine back in the God, it was like 97 or something. And he was younger than I was at the time. He was just, fresh out of UCLA. And I remember him saying, and he used to go to the UCLA library, and it's Dave. Dave, if you're watching from Australia, hey, this is about you, bud. I owe you a call and we need to talk. But anyways, Dave Boyle, great trader. And he would go to the UCLA library and use the Juan Maroon books, which were weekly charts. And this is something that Bill had started back in the 60s, 70s. I'm trying to think when the first book was out. But anyways, he had those forever. They were called database books, and we refer to them as maroon books because they were maroon in color. And they were like this thick each week. And there was two volumes, one volume like this and the second volume like this. And it had basically about 3,000 stocks in there, all weekly charts with an earnings line. And he just made this observation. I've heard other people say it since, but I'd never heard anyone say it before him. And he didn't come up with it, but it was an original observation that I was like, wow, this kid is smart. I was a kid too, but he said, given enough time, stocks just follow the earnings. And that just went in one ear and stayed there. And it hasn't left ever since, because if you notice an earnings line, the stock will overshoot on the way up and overshoot on the way down, but given enough time, it'll just pretty much go in the direction of those earnings. That poses a big problem for us, because that's the earnings that have happened are completely different than the earnings that are going to happen. So if you're basing it off of, okay, this earnings line was this great, had this great trend and it was very stable and everything, but you don't know that that's going to happen in the future. And I'll tell you the dirty little secret, man, that it just takes any level of working at looking at charts, um, that the fundamentals, man, they don't do you any good on the way out. If you're a fool, well, I'm not going to say, shouldn't say that. It's just someone got under my skin once who told me I was supposed to go to a seminar and teach people that they needed to sell on fundamentals. And I'm like, I don't care if you're a VP, and I'm not at that time because I ended up being a senior VP. But this person was a VP and was instructing me, and we got into it and she said, well, Mike, that might be the way you do it, but that's not the way Bill does it. And I'm like, I don't know what you're smoking, because we buy on fundamentals and technicals and we sell on technicals. Let me say that again. We buy on fundamentals and technicals. So you use the fundamentals to decide what it is you're going to buy and use the technicals to time that. But you do not wait for the fundamentals to roll over before you sell, because then that stock is going to be in the dirt. The stocks act way too quickly. So that's very important, and a lot of people don't know that. So what will happen is you get this stock that's been running and it has great earnings, and they'll post their best earnings ever, and then they sell off, and then they never come back. And you have all these people who are like, but the earnings are great, and now the PE is better, and the price of sales are better, and the margins were excellent. But the market knows and is selling off because saying those are the peak earnings. That's as good as it's going to get for a while. And then that stock comes down, and sometimes they come way down. So never get trapped into the earnings. Once you've been in something for a while and it's done really well, you need to sell on the technicals. And I'll tell you, like, one of the things that we did at the firm, we had Enron. If you're younger, you probably don't know Enron. If you're older, you definitely know about Enron. And so if you're younger, just Google it to understand. But it was basically a fraud, but we had it on our service, the NESME service that I did with Bill, that was for institutions, and we had it on there. And the earnings were great because they were made up. Of course, they were great. All the numbers looked perfect. It was like, wow, this is great. But then the stock started rolling, and we just removed it from the list. Didn't think anything of it. Didn't think it was a fraud. Didn't know any of that. And then ultimately, it just rolled and collapsed and turned into what we know now. And that was such a great example because it was telling you that the market always knows, and it doesn't matter what what you get on that press release of the earnings and the sales and what the CEO is saying about the future and the conference call Q&A and all that stuff, man. If that stock is going down, someone's seeing something in the future because it's about the future. So there's a lot that I said there, and let's just kind of recap. Given enough time, a stock is going to follow what the earnings are doing. And so that's why it's better to just kind of wait for something to already have a good earnings track record and use the chart to time some buys, and then ultimately use the chart to time the sells. But so the fundamentals are really about your selection process, the pond to fish in, so to speak, even though I don't fish unless there's no hooks involved. I'll get into that. I'll do one on that. But so it's the pond to fish in for your position trades, right? Their quality, sales, earnings, return on equity, margins, you name it. So just make sure that you're aware of that as you go through, and don't get caught into that thing where, oh, the earnings are so good, the stock should go up. Well, if the stock's not going up, doesn't matter what they should do. Maybe eventually they will. But again, given enough time, that the stock will follow that earnings. So that's why the earnings estimates are important, but they're just an estimate. And that's not for today. What we're going to do today is going to be focused on the quarterly earnings. I have created some different screens. I don't think we're going to get through all of them. We'll see. Just some basic quarterly earnings screens. And I also have, some acceleration screens of earnings, stable earnings, as well as just really fast earnings. So we'll probably break this up into several of these because I'm trying to keep these on the shorter side. So this is probably going to be part one of a multi-part series on just quarterly earnings. We'll see. If I'm flowing and don't get too hungry, maybe we'll do all of them. I don't know. And then we'll do another episode on that covers estimates, and another one that covers annual earnings and so on. So, okay. So here we have the different screens that I built for this, starting with the EPS loose or quarterly loose. This is probably a good time. Again, I say this every episode, or I mean to. I've got it in the writing, but it is important legally and all that good stuff. Is I am not an investment advisor. This is not investment advice. This is me just trying to pass along what I've learned over the years. And you know what? If you have trouble sleeping at night, throw this on. I do sometimes. If I really cannot sleep, I will put on one of my episodes, man, and it does the trick. But sometimes it wakes me up even more because I'm like, oh, God, man, no wonder why no one's watching that. You do ramble on a lot and say, you say 10 words for every 2 words that really need to be said. But what are you going to do? All right. So enough of that stuff. This is your very basic quarterly earnings screen, and it is just 2 parameters. So this is not helpful at all, but I just wanted you to at least know the universe that you're dealing with. So get to know this area up here. This is Market Surge if you're not familiar with it. So it's telling us the database of stocks and ETFs and closed-end funds are almost 11,000 stocks. Then if you say the most recent quarter, has to be up at least 25%. Then that brings it down to 2,200 stocks. Then you get rid of a lot of ETFs and things, but there's a ton of those. And then this here is the 1 quarter ago. And also saying that that's 25%. So now you've got 1,400 stocks. Well, you can't do anything with that. I look through way more stocks than that in a given day, but not specifically just based on what the earnings are. Now, here is where it is. It's under the earnings section and it starts with number 4. And you want to click this. And this is, if you ever wonder what something is, just click on the thing and it will give you the little definition of it. And this is not customer service. If you've got customer service questions, ask them. Please, please, please don't DM me with your customer service questions. Thank you. So, but what you want to do is click on this little thing because this is going to include negative numbers in the comparison. And that was a Bill idea. And this came out in the 90s because you had all these stocks that weren't earning anything. It was like minus 50 cents versus a minus $1.50 the prior year. And that wasn't really what he was after. He was really after the stock that earned 5 cents this quarter, but last quarter was minus 50 cents or minus 25 cents. And he wanted to have a number on there, not just, we used to have an NA or a little hash mark in there, kind of like these little hash marks, and that would drive him crazy. He would always want to have a value in there. So that's where we started doing this. And it bothers some people because they want a positive versus positive numbers. And I totally get that. But this is just how I've been doing it for a few decades. And it's how Bill liked to look at it. And it's how I'm always going to look at it. But if it bothers you, man, do what works for you. But so this was just our loose screen. I'm not going to do anything with that. Let's go down to our mild screen here. So we've added a couple other parameters. Same thing, most recent 2 quarters, and then just put a lease above $10 and above 5 million volume. This is not share volume. I've talked about this in the past. This is dollar volume. So how many dollars are actually flowing through this? Where is that in here? So that's number 29 there in the price and volume. So dollar volume, not share volume. So that 5,000 there actually translates into 5 million because we just like to confuse people. I think it's silly. And hopefully we can change that at some point. So at 520, so that's much better, but let's see if we can make that a little tighter. So here's our medium. So loose, mild, medium. So medium, this is still the $10 in the $5 million volume. But what we've done is put each of the last 4 quarters have to be 25% or higher. And that brings us down to 250. Now, there's no technical stuff on this one, but let's just kind of look at some of these numbers of what came through here. So let's see, we're going to sort it by, what should we sort it by? The EPS percent change the last quarter. So do it one more time. Okay. So this one here, PEN, PEN 8,700 for this quarter. I'm just showing you how to read this. And you can just customize this your layout here, go to custom layout and choose from here. And if you don't know how to do that, just call customer service and they can walk you through it. Don't call me. Then you've got last quarter was 102%, quarter before that 28%, quarter before that 27%. And so let's just look and see how that looks on the chart itself. I'm going to go to the weekly and scroll down into this area. So it's saying 27%, 28%, 102, and then it's maxed out. Our display can only display 3 digits. So instead of the 8,700, it shows that it's 999. Another thing that drove Bill crazy and drives me crazy, frankly. So we've got this earnings line. You can see it's really disconnected from the price over the short term, which is kind of unique. And if you have like a value bent to how you're wired, this is kind of something that you'd want to see. This earnings are being disconnected from the price in the intermediate term, and then looking for an entry point on it. But typically, if, like I was saying before, is that the stocks top when the earnings still look good, that this could just be that the earnings aren't going to be coming back, and if this green line here, that's the earnings, that if it does roll, then it'll come in line with the price. But that's a topic, value trading and stuff. That's not something I do, but I totally understand it, and I understand why someone would want to do it. And in the right account, done the right way, I think it does add a lot of value, frankly, because you would get that kind of true diversification, because growth stocks and value stocks tend to trade differently. And when growth stocks are going up, value stocks tend to go down, and vice versa. So if you're primarily, let's say you're 90% growth stocks and you've got some value in there, on those bad days, in theory, those value stocks should at least be going down less than your growth stocks. But I don't know if we'll ever talk about that, but we could, because like I said, that's a whole different way of doing it. You've got to understand other styles of trading, even if you choose not to trade that way, because it'll help you in the market and go, oh, okay, this is why those stocks are going up, because the market is iffy. And so all the money is flowing into the low value, the low PE, the low price to sales, and so on type stocks, because the market is uncertain. And it will help give you an understanding for the market, even if you don't trade that way. So it's just good to know. So let's look at another one of these. Oh, let's look at GME, GameStop. Stop. So this one, the quarterly numbers, I mean, really solid numbers, 500, 36, 233, then maxed out at 999, which was down here. We can see is 2,400. So really good earnings, but you can see that the price is disconnected from the earnings, because it's obviously trades off of other things, not, cats are involved and stuff. I don't know. This was the one about the cat, that kitty guy, whatever. Yeah, I watched that movie in the theater. It was a good movie, very entertaining. Roaring Kitty or something like that, man. Just more power to him. It really disrupted a lot of things. So, man, I've got nothing negative to say about it. Got a lot of people interested in the market. So, dude, more power to you, brother. Okay, so now we're going to go into this one. We're just saying 25% across the board, pretty straightforward. Then we're going to go into tight. What did I build here? Okay, so $10, bump this dollar volume up to 25 million, because that's more how we look at things at the firm. And this is an important thing that we did. EPS trailing quarters, saying it's at least positive, because that's something that Bill would want to see, that the earnings line is actually coming positive, meaning if you add up the last 4 quarters, that it was at least a penny. I know that doesn't seem that strict, but he wouldn't trade them if they had negative earnings growth or negative earnings on a quarterly basis. So he'd want the last 4. He'd prefer the last 4 quarters to be positive, as well as the most recent quarter to be positive, meaning that it earned at least a penny a share. The higher, the better, but that was his bare minimum. So just having that requirement in there, you can see it got down to 1,500 stocks. It would put a couple basic things in there, like price over the 50, price over the 200 day. That's not too restrictive. So that brings it down to 560. Then the same things that we had in the last one. So let's look back at the last one. Just focus your eyes on here. Probably best to watch any of these ones that I do screening on, like a TV or a really big monitor, so you can see all the custom screen stuff. And you can obviously watch YouTube on your TV in a lot of ways. And I'm an old fuddy-duddy. How am I going to sit and explain to you guys? You should probably know how to do it better than I do. But if you don't know how to watch YouTube on your TV, go to Google, because it is it's pretty. I watch YouTube on my TV at night all the time. Lots of great concerts and stuff. Okay, so here we've got those same things that were in the medium, these 25, 25, 25, 25, 25. And you can do, these aren't set in stone, but 25 was an important number to Bill. And so I just kind of put it in there as a placeholder, and I'll adjust accordingly. And I'll always be looking at these numbers to see, does it do the number of stocks kind of do something funny over there, like where you wouldn't expect it, and then kind of delve into that or dive into that data. And that's a topic for another day. So 48 stocks. So not much. Let's look down here. The trailing 4 quarters earnings. That was this value right here. So it's saying this fix is earning $23.37 if you add up the last 4 quarters. So not the annual numbers, which that's a topic for another day, but actually adding up the last 4 quarters. So the 825, the 653, the 450, and the 409. These numbers right here, if you add those up, that's should be that value there. Let's do the smallest one. And so at 30 cents, so SoFi. And I don't have a position in SoFi, but just because I closed down my brokerage account and I recently did a shotgun approach where I bought a lot of things. I'm recording this on November 3rd, that just assume any stock that I talk about that I have a position in, because I don't know when this is going to be released. Probably this Saturday, but maybe a different time. But okay, so 30 cents. So just adding up these 4 should get you there. Sometimes we get apples and oranges data in there, and so it doesn't add up, and that's another topic for another day. Man, lots of topics for other days. I guess we've got to do more of these episodes. Then let's look back at this other one, the medium one that didn't have it. So this was this screen, the medium one, where we didn't have those extra things. And I just want to give you an idea of why this trailing 4 quarters is so important. So look at this TNXP, this biotech that have these big numbers, blue numbers, up 70%, 71%, up 80%, all the way, up 99%, 99%. But look at the actual value that, losing, man, a ton. Even now that it's losing less, it's still losing $3, almost $4 a share on a quarterly basis. So that is complete, and that's why the stock looks like this. Let's look at another one, Grail. Sometimes they look like this because it's a story, because it's clearly not trading off of sales, because your sales growth, which is over here, isn't growing fast enough. So story stocks are going to be disconnected from their earnings and sales, just because that God, I'm just trying to say that's a topic for another. That's my way of saying not going off on tangents, because this is back to the basics, or back to the beginning. My nod to Ozzy, rest in peace. That if you don't know, right before he passed, they had that big concert over there on the other side of the pond. And man, I wish I could. I think it was on July 5th, right? And I couldn't, just from memory. And it was called Back to the Beginning. And then he passed, and that's what this series is dedicated to Ozzy. Man, I never saw Ozzy live, man. That's wrong with me. That's why I try to go to as many concerts as possible. This weekend, I went to go see Mammoth with my good buddy, Joe Fahmy. That was so much fun. And man, that's Myles Kennedy opened up for him. Myles was just unbelievable. I got to meet him briefly after with Joe, and we got to go backstage, and what a kind fellow he was. And my basic same age bracket as Joe and myself. And so we started just talking about the market. And I was just so impressed with his knowledge, and just briefly, you can tell by what questions or what people say and what they don't say, kind of where they are. And wow, as a rocker, I was not expecting him to be that into things. Like, he really, really seemed genuinely interested in the market. So what a cool dude. And we will see. I'm hoping to go see Mammoth again this week. Anyways, Mammoth is Wolf Van Halen's band, and his new album out there, The End, is just unbelievable. So it's his 3rd album. I'm going to do a Rambles On, because this is my podcast. I can do whatever I want. So you need to go and listen to that. So Mammoth 1 came out a few years ago, then Mammoth 2. Mammoth 2 was better than Mammoth 1. And it's so rare for the second album to be better than the first album, and it was not that the first album wasn't great, but the second album was better. And the third album, and you just can't have a third album be better than a second album that was better than the first album, but he pulled it off. Like, it is so much better. You can just tell that kind of is just really letting loose on this one, and man, some just great songs, great playing, and he plays all the instruments, the drums, the bass, the guitar, the vocals, and but then when they play, they obviously have a band, and Frank's in there, and met him, and wow, what a kind soul. And met his wife just briefly, just said hi to her, and just they just seem like a really cute couple. So anyways, enough of that. Why did you get me on that tangent? I'm supposed to be talking about earnings. I've got my better half is making some spaghetti and gluten free. I'm hungry. Why are you getting me distracted? Shame on you. So here are all these negative numbers. Let's look at it real down here. So they're not all created equal, right? So this is minus 24 cents over the last 4 quarters, minus 9 cents, minus penny, minus 8 cents, and so on. But on the earnings line there that they decided to draw with a best fit, which I wouldn't have done, but so we're going to change it and give it a different option where you wouldn't even see an earnings line on here because it would be underneath the price because it's still negative. But it should really be done on a 20 times scale. But we'll make that as an option and keep this as an option. But the benefit of having this on a best fit is that you can see how stable the earnings are, and pretty stable for something that is growing that rapidly. But you can also see when the earnings line kind of slows down. So it's good to see the slopes. Even though you can see it in numbers, it's better, I think, visually to see the slopes. And that was a big deal for Bill. So again, this one doesn't have it as negative. And if you wanted to, you could do something in between and maybe say, oh, it can't be down more than X, like 50 cents or 25 cents over the last trailing 4 quarters. Okay, so this was that tight one. And let's look at those parameters again. So 25% for all of those, above the 50 and 200, and at least a penny. And let's look at some of the other ones that are earning a ton in there. Oh, Lily. This is kind of classic, right? That this is exactly what you're looking for if you're just looking at it from an earnings standpoint, where on a quarterly basis, you have this ramp up in there, 495%. And I would go and, make sure that there aren't like charges or gains in there that we haven't been able to back out. So when you see big numbers like that, you do want to investigate it. So that's when you have to dust off your research hat and actually go out and do that. The easiest way is just start at the company's investor relations department, look at their earnings press release, read through it. Back in research, that's one of our job functions that we would do. You'd get your earnings, you'd have to read through it, see if there's anything extraordinary in there, any gains, any charges, and then back those out to make them comparable numbers. And something just feels a little funny with that. It's a little bit too fast. So the other thing you could do is listen to the conference call to see if there's any additional color on there. But let's just assume that these are real numbers, that's exactly what you want to see, something ramping up that quickly. And here was really kind of your inflection point there, but the stock hasn't gone yet. So if the theory that I was saying is valid, which I believe it is, because that's what I've seen over the years, that the stock should follow that earnings path. So it should move higher as long as those earnings continue. But so that's more of like what I would say is a value play. Like I would look at that as a value trade because the chart doesn't look that good, but it's really about the earnings. Like you wouldn't even be looking at a chart like that if it didn't have those types of sales and earnings. Okay, here's Amazon. I do have a position in this, and we have it on Swing Trader. Let's look at those numbers. So it's passing all of them. You don't like to see this general deceleration, meaning going from really big numbers down to lower numbers like 33 and 36, but it's still passing your basic requirements of the 25% for all of those quarters. And the trailing earnings are at $7, and you can see, that is doing what you'd want it to do. VRT, go down to those numbers. Again, this is more what you'd like to see because there's a pickup in earnings. It's not a pure acceleration because goes from 49 down to 42 and then up to 63. But what I classify as a general acceleration, where it's, in the 40s and then moving up higher than that. So let's move on to the next one, acceleration. So this is acceleration loose, and acceleration was a big thing for Bill. In fact, back when I was in the research department in 97 through the end of 99, when we do those earnings, they have these things called hot stocks, meaning there was different variations, but basically if the company was in a position to have, they already had 2 quarters of acceleration. So meaning the last 2 quarters, the most recent one was higher than the last one. So another way of saying it is like the most recent quarter was up 25%, and then the prior quarter was up 24% or less. That meant it was in position to have 3 quarters of acceleration. So let's say 24, 25, 26, or preferably bigger numbers, but that would be acceleration. Those were called hot stocks. That meant we had to do those right away. We had these wire monitors who would go into this room that was just this big printout of real-time news. Like, it's just mind-blowing to think that it was done this way. Then they would rip up. We didn't even have the internet on our computers. It was at first, and eventually we got it so we could look at like SEC filings and things, but we couldn't like go off on Yahoo and stuff and search for things. But anyways, so they would print it, they would tear it off, and they would bring it over to your desk, and you'd have to go through it quickly. And if it accelerated, you'd have to make sure that you did those numbers right, and then you would have to fax those results to Bill's home, because back in the day you used to trade from home, at least the mornings. And so that was a big deal to him. And lots of times he would just buy, if there was I'll do a whole one on that, because they were called hot stocks, and he would look at the sales as well. And sometimes he would just buy them regardless of what the chart was looking like. But so the acceleration is a big deal, or was a big deal to him, and it is to me, because it's just a sign of an inflection point where it's growing at one pace and then it starts growing at a faster slope, and that can really move the price for a lot longer than you would think. So current price over $10, over $5 million volume. And then we've got this one here, earnings acceleration. This in the quarterly right here, and you can just read about it if you want to know about it. But anyways, just click that to a yes. That brings 3,600 down to 383. And then we just put this thing in here, the most recent quarter up at least 25%. Now, I will tell you that Bill was not as picky about the 25% if there was acceleration. He would put it as low as like 15% if there was acceleration. So let's just change this to 15, see what we get. 168 goes to 230. So not bad. Let's look at some of these smaller ones. Let's do Ryan. Okay, so 11, 14, 15, and that would be, actually, he would be fine with that. Now, that in isolation, but what would bother him is, okay, you're growing 11, 14, 15, so it's accelerating, but what were you at recently? So recently you were in your 30s down to your 20s, so he would classify that as deceleration. And you can see the stock is doing well when it was growing at its 30s. And then once it starts slowing down, you can see that with that earnings line, the stock starts rolling. And so again, like my buddy Dave used to say, the stock, given enough time, the stock is just going to follow what the earnings are doing. So this is something that he would not like. So let's go back and let's put that back to the way I had it before. We'll put it back to 25. And now, let's do something fun. Let's put this up to 50 and see if we can see some acceleration. That brings it down to 75. Let's look at some of these numbers. Okay. So let's see, take 2. Growing, maxing out here at our 999s, but it's accelerating. So this is something that you'd really want to look into. It doesn't mean you buy it, but you look into it. Here's the Lily again. All right, so we're going to go back and put that back to where it was at 25. And let's go to the next one. So this is the acceleration type. If I was building a screen for Bill, this would be more like what I would use. So current price over $10. We raised the dollar volume up to 25 million, said it's at least above its 50 in the 200 days. So that brings us down to 1,000 stocks, saying that we want that acceleration. So 124 names. Then we put the requirement, the most recent quarter is 25%. And then the one before that, 20. So we don't say 25 and 25. We allow it to go 20. And then the quarter below that at 0. And really, if I was building that for him, I'd probably put it at 10, just because he was fine with that slower growth and then coming up. So only 19 names. Let's look at a few of these. Let's just sort it by, for fun, let's do forward PE. So the highest first. Let's just look at that. So the most expensive on a forward basis. So you've got acceleration goes 18, 43, 56, but those numbers are also coming in there, meeting our requirements. You get the PAN-W, otherwise known as Palo Alto, looking pretty good. Let's not sort it by PE, because I was just kind of doing that as a joke, because I'll do one on PEs. Okay, so let's do the largest earnings on a trailing 4 quarters. So the largest amount of earnings, $26. It's not really, well, man, lots of cans of worms. But so let's look at this. 20, 24, 42. In isolation, that's beautiful. Now we look back further to see before the most recent quarters, what was it doing? And, it was a little sporadic, but it was 5%, 25%, and 9% here in the 20s. So it was kind of all over the place, but positive. But now it is really accelerating. And you can see that on the chart, that it really feels like an inflection point that started around over here, looking at that green line. And let's look at it on a monthly. We're going to be adding the earnings line on a monthly, because that's the most important place for where it should be. I don't know why it's not there. But here, if you were visualizing that earnings line, it would be ramping up. But let's look at where we can on the weekly, and let's just zoom out so we can get a little bit more. In fact, you can move that and you can get rid of, let's see if the data boxes doesn't get rid of the earnings line, does it? Okay. So we just got rid of those, and we're zooming out on the weekly to get a better picture of that earnings line, so you can see what it's done there. And so you're looking at the slope here, then it changes, and look at what happened. The stock fell. Earnings were rising, stock was rising. Earnings went flat, stock went flat. Earnings were rising, a little bit of a disconnect there, but then eventually they came down. So it's over time. Look at earnings rising, stock was rising. Earnings were flat, stock was flat. Earnings are rising, stock's kind of rising. Now we've got this. What happened to my earnings line? Okay, there it is. So you can see this is where your acceleration is happening, and the stock is starting to pick up. Doesn't mean it's going to continue, but that's how you would look at it from more of a position trading standpoint. We're going to zoom back in so we can see this a little better. Okay, now let's look at, let's go on to another screen, because otherwise we're going to get bogged down here too much. So stable earnings, that was a big deal for, I guess we are going to try to power through these. That was a big deal for Bill, having very stable earnings, and that's very important to me as well. Anyone who studies earnings lines over long enough time frame will realize how important it is to have stable earnings, because stable earnings means relatively predictable earnings. And if you're a big institution who's not trading a lot and you're trying to keep your turnover down, you want something that's predictable. Predictable then will have a higher valuation on it, because you're paying up for stable earnings. And this number that we have for stability, so again, we just have the normal price and volume requirements, but the stability rating, just to confuse people, we did this one in reverse. So the lower the number, the better. We normally do the 1 to 99 thing, and with the 99 being the best. Here, we did it. I don't know why Bill decided to do it that way, but that was long. I think he came up with this long before he had the newspaper and everything, and it just kind of stuck. We should probably switch it, but then it would probably mess people up. So if the earnings are all over the place, then you're going to have a 99, because this is just a best fit sort of for, to just keep it simple. It's like, okay, the earnings super stable, I'm going to have a number closer to 1. Earnings all over the place, a number closer to 99. So the more you play with this, the more you'll kind of get a feel for what that number represents. So 20 is about as far out as you'd go to say something as stable earnings. So less than 20 is what we're looking for. So that's 900 stocks. And then some just very, very low earnings growth. Notice we only are requesting or requiring 15% on this screen for the most recent earnings, and 10% for the one before it, and 5% for the one before that, because Bill was fine with that. If it was super stable earnings, he was fine with smaller growth, especially if there's some acceleration in there. So let's look at this one and look at the most recent earnings. Wait, is that our stability? Hold on. Yeah, that's our stability rating right there. So this is the most stable at 20, and you can see that's, oops, that was the wrong stock. It's not perfect there, but let's look at the most stable. Okay, that's with a 2. Super stable, and look at that earnings line. Just really very, very predictable. That's a major disconnect. This is a major, major disconnect. Earning like that, but the stock falling apart like that, that is not normal. So there's got to be something funky going on there. But that is like a big warning sign to me. I would stay away from that, because ultimately, the earnings will probably catch up with that price. But at least that's how I look at it. I'm not saying to trade off of that. But again, this is more of a disconnect where the earnings are growing like this, but the stock is going down. So if the stock is going to catch back up to it, then you'd be looking at a place to buy. But you'd also look at the annual estimates going forward. But we'll get into annual estimates in a different one. Let's look at CBOE. So stable, and this is more in where we want it. Some general acceleration from the single digits up to 20%. And let's go to the weekly, and let's just zoom out to see more of that earnings line. And you can just see how in general it's stable. That's a beautiful, beautiful earnings line. Again, that's that green line. Let's zoom back in. And let's go back over to our lists, and we're going to do our stable tight screen. So $10, $25 million volume, stability. Now we lowered this down to 10. So 10 or less, that's right here. Then we raised up the earnings requirement, 25%, 10%, 5% for the last 3 quarters. The trailing 4 quarters is at least positive, so up a penny. And then what did I do here? Let's see, EPS trailing 4 quarters, and then EPS trailing 4 quarters greater than, it's this one here. So that it was greater, if you tally up the last 4 quarters, that is bigger than the 4 quarters before that. And just another way of basically saying it's growing. It sounds more complicated than it is. Then above the 50 and above the 200. But again, you can always read those. And let's look at this. So this is going to be more of our quality list. Let's just sort this from the most liquid. So you've got Broadcom in there. Let's go down to these quarterly numbers. So really solid numbers in the 30s, up from the single digits over there. Let's look at ISRG. Do have a position in this one. That's been very, very stable. Let's see, like ANET, that a lot of people are interested in. Stable and fast growing. So that is why it's had such a beautiful move. Now it's had trouble over here, but anyways, I think you're getting the picture with that. Let's just power through this. We got 2 more screens to go. Heat. So some of you want something that is growing really quickly, and so do I. So we are going to go into the heat loose. So this is just saying stocks above $10, above $5 million volume, but the earnings are growing pretty quickly, rapidly. 50% the most recent quarter, 25% for the prior two, and you'll get, and that's all, and just only 219 stocks. So you can easily go through those to get a sense for what you're dealing with. So here we have our EPS heat, a loose version. So above $10, above $5 million volume, and then we've raised our requirement here. So above 50% above for the last quarter and 25% for the prior two. So let's see what we've got here. AROC and some solid numbers in there. Stock has been going sideways for a while. Oh, it's oil and gas, so but still worth looking at. And this one pretty disconnected. Earnings are, but the earnings are all over the place. Let's go down and see if we can find something worth. Okay, so the NVIDIA that so many people are in, I do have a little position in this. And see, earnings are rapid, but there's this general deceleration, but you want to put it in the context. These are such big numbers that they're dealing with that you can't be growing at triple digit numbers. So you do have to use the mind for the context of things. Now let's go to the heat tight. This is more like the loose screens. I'm not going to use as a targeted screen. I might use a bunch of loose screens and dump them in together, like a sales that are loose and earnings that are loose and a this and that are loose, and just dump them all into one list and play through them. But if you're just trying to really target something, that's where the tight ones are. It's not like you don't use the loose, but it's just that might be more on a weekend where you have more time. And then during the week, you might go with your tighter screens. So let's see, what do we have in here? The above $10, above $5 million volume. And I put this in some pretty strong numbers. Last quarter up 75%, prior quarter up 50%, quarter before that 25%. Then we put on there the trailing 4 quarters are at least positive, so up a penny and above your 50 and your 200 days. So probably some good merchandise in here. In fact, let's just bump this up to something a bit. No, you know what? We'll just leave it as is, and let's see what do we have in this. Let's sort it by dollar volume. See the most. So probably a lot of names that certainly a lot of names I'm trading, and a lot of names you guys are probably familiar with. Here's Credo. I messed that one up, and look at that growth. All right, so I kind of save the best for last. This is. I'm just going to play through this, and again, I've got positions in a lot of these. So, like Palantir, I've got a position in, and look at those numbers on there. Let's go to Micron. Wish I had a position in this. Solid numbers. Here's some Hood. Got some of that. Just really, really good numbers. APP. It's going through some unusual things right now, but the numbers have been solid. Here's that Lilly that we talked about, SoFi. So things that you're probably really, you've been watching, but this is more of your quality list as far as stocks that are growing rapidly and at least, relatively liquid. Okay, so let's see. There's so much more to talk about, but here, I'm going to stop sharing. But we're going to stop there for the earnings. In future ones, we'll do annual earnings. We'll also tackle earnings surprises. That's a big deal for me. Earnings revisions. We don't currently have a way of screening, but in the future, when we do get that, I'll do one on that, because earnings revisions are a big deal for me. Really, really big deal. Earnings surprise are a big deal. Annual numbers. So we'll look at that, and then after that, then we'll start going into the other things like margins and return on equity. But we'll probably do some normal chart work in between. I got to do some model book ones. Plus, I want to do some interviews with some folks. I have so many people that I want to that have agreed to come on the show. I've been traveling so much that it's just been very difficult, because I don't want to record one of these on the road because it's more likely for something to go wrong, and I don't want to waste someone's time who's already allocating it to this show. So that's what we've got going on. I hope you guys are enjoying this series. I read all of the every single comment that you guys make on whether it's on X, my handle is mwebster1971, or on my Webby 5150 channel on YouTube. I read all of them. I haven't commented back on every single one, but every day I try to like make forward progress in answering those. But they mean the world to me. Like that's what I'm, like that's what I get out of this. I'm not charging. I could charge. I was reading one. A guy said like you could charge 1,000 per episode or whatever. Wouldn't get a lot of people, but I could charge hundreds per episode. Just have to edit it down. But I'm choosing not to. I'm like leaving all that money on the table because I'm trying to help you guys out. So watch them. I think a lot of times when something is free, someone else said, when something's free, like people treat it that way. Like, I don't have to be doing this. I'm trying to help you guys out. So watch it, rewatch them, especially trying to sleep, rewatch them. And the other reason why I'm doing this, of course, as I've said on my extended versions, I wanted to leave something for my kids. They don't trade. I never wanted to push them into anything. I always wanted them to do whatever they wanted to do in life and just to find their own path. And they've both found their paths that they want to go on. And I'm in favor of that. And if they want to change their path, I'll be in favor of that too, man. I don't want to push anyone. I don't like to be pushed into doing anything. And so I don't want to do that to anyone, especially not my kids. And so it was in case they ever find a time in life where they do want to trade, learn how to trade. I want them to learn from me, and I might not be around. You just don't know how life is going to play out. So I wanted a record of something, and so I was just going to record these and just stick them on a computer somewhere on the cloud. But I was really paranoid that I was going to do all of this work. This is a lot of work of teaching this, and then it was just going to go away. And so I thought the best way is create a podcast. And the good thing and the bad thing about the internet is anything you put on there never goes away. So I say a lot of things on here I shouldn't say if I was smart, but what are you going to do? I'm not that bright. But so this is for them. And really, I don't know that they're ever going to get into trading, but I'm hoping that they have kids one day, and I may or may not be around. And I wanted them, my grandkids, to learn from their grandpa. And that's why I'm doing this. So just put up with the ramblings. I'm going to get back into my full ramblings. I've been trying to do these back to the beginning ones with less rambling, but frankly, that's a bit of a drag. It's more work trying to go, oh, hey, don't talk about that. Don't talk about that. Don't talk about that. And I'm going to get back to my normal my normal pace. It is called Webby Rambles On after all. But with that said, this is the time to remind you that each one of these episodes, and I'm dead serious about this, is that what I ask is that you do at least one kind thing for somebody or something, animal and insect, a friend, an enemy, stranger, doesn't matter. Just do one kind thing per episode. I'm deadly serious about this. I really think, even though there's not a whole lot of viewership with these for whatever reason, that if we just start a movement, in people being kind, and think about it, this is the 45th episode, and lots of people have watched these and not as many as I like. But if each person is doing something nice and spreading the word, just say, hey, just try to do something nice for someone today. Just, it might not, if that, it's kind of like that butterfly effect, right? This is like this tiny little butterfly flaps its wings on the other side of the world, and eventually it turns into a hurricane somewhere. I don't know, something like that. The same basic concept. You start off small and it might have an impact. And I'll tell you, I'm going to do one of these on why I've become why I became a vegetarian, like 35 years ago. And it was in part to try to, and I didn't know about vegetarians at the time, but it was my way of trying to be kind to animals and help decrease the demand, even just one person's demand. And at the time, there was no vegetarian menus and stuff anywhere. And being a vegetarian or a vegan I'm essentially vegan, but I eat a little cheese. That just it's hard to eat out and not, to find vegan stuff everywhere. But anyways, I'm going to do one on that. And it's not to try to convert anybody. I'd stand the vegans and the vegetarians or the people, the PETA folks and stuff that I think they turn so many people off because they're doing it the wrong way. Like, no one wants to be told what to do. You just put out, hey, there's this different point of view for this reason, and you can take it or leave it. But I'm going to do one on that. But I guess I just did a mini version of it. But that was my way of being kind. And it started off small. And I think there was a lot of people that, have been, doing this for decades and centuries. I don't know how far back it went, but, where it's not unusual. You go to a restaurant and lots of them will have like a little V on there for vegetarian. And so it's slowing the demand for the hurting of animals. If you're a hunter, fisher, whatever, like, hey, I don't have anything against you, but growing an animal who's going to be in captivity their entire life just to be killed, dude, really? Is that kind? I mean, think through it. So, but man, dude, if you put anything negative about my thoughts on on the thing, I'm not telling you what to do or what not to do. I'm just saying, man, just think about it. But I will come back at you so hard. It's not even funny, man. Do not be that person. If you don't agree, don't watch. I don't care, man. Or just don't comment. Don't need to hear it. But with that said, that's your act of being kindness towards me, because I don't like negative comments. Really get under my skin. I could be doing something else with my time, but trying to help you out. So anyways, go be kind, go do something nice. And I hope these fundamental ones help you out. It's such a big, important part of, especially for position trading. I know I talk about swing trading all the time, but it's an important thing to do. It's an important way of looking at things for position trading, because you cannot position trade with just charts. Well, I mean, you could, but I think in the wiggles and the wobbles that eventually happen, it would be very difficult to know what is your A quality stock and what is your B quality stock and your C quality stock, because you can't hold them all as the market is starting to roll over, because lots of the rolls are just like temporary. It's no big deal. It's like down for a couple of days and then they go right back up to new highs. But sometimes they start going down. You turn into an intermediate correction that turns into a bear market. Along the way, you've got to be scaling out. And that's where the fundamentals come into play. Those are the ones where you want to get rid of your junk that have poor quality earnings or sales or margins, and just hold on to your quality ones till the end. But I hope you guys got something out of this. And again, I didn't want to end on a negative note. My intent was to go on a positive note. That I read these comments and it just really puts a smile on my face. In fact, it's the first thing I do when I wake up in the morning is I go and look at the comments. I used to just look at my stock stuff first, but it's the first thing. It's like, so and so, or some people put all these really nice comments in there that I always look forward to. So many different people. Ron, you're one of them for sure. Always the nicest comments, and lots of other folks in there. And so I really appreciate it, especially the people who say, oh, I never comment on a thing, and I decided to comment. So thank you. Sincerely, I really appreciate it. And as I've said before, you could probably pick up on it. I'm going through a tough time in life right now, like as hard as life gets. So that helps a lot, and that's why I say to be kind to folks, because you never know what they're going through on the other end. And you can make someone who's having the worst time of their life a lot worse, or you can make them a little better. And, so a lot of folks have done some nice things. So I really appreciate it. So with that said, let me know what you want to do on future ones, because we're not going to just stick with these fundamentals for a while. I'm going to go back and want to go through all the patterns. We'll probably do like double bottoms, cups without handles, saucers, sending bases, high tide flags, things like that. But I want to keep this interesting. And then let me know who I should interview. Jason Shapiro is probably going to be next. I'm really looking forward to that. And I've got a bunch of cool people who are not some people that you've never heard of, that aren't big time traders or anything like that, or market wizards, but they're just people that I'm fascinated with, and some that aren't even in this industry that I'm going to have on the show, because I want to talk to them. And I think that you guys could learn a lot from them. I certainly could. And so I'm probably going to start as we go into next year, do more interviews, because I like them, but I'll try to keep them shorter because folks don't have 3 hours to spend with me on this, and I get that. But anyways, with that said, thanks for putting up with my rambles today. Peace out, guys.